Welcome to this video on navigating 0% APR promotional credit card debt when cash flow is tight. Today we'll transform a looming crisis into a focused plan. We'll use a real-world scenario. Balances over $23,000 and only $1,000 available monthly, while minimums total around $2,000. First, we'll explain why 0% promotions can backfire. Next, we'll switch strategies from paying off debt to minimizing catastrophic future interest. Then, we'll prioritize using the debt-avalanche method targeted at the highest future APRs, with a critical exception for deferred interest traps. Finally, we'll fix the cash flow gap by increasing income and cutting expenses. Let's begin. Here's our agenda. First, we cover why 0% APR promotions can backfire. Next, we introduce the strategy switch from aggressive payoff to minimizing future interest. Then, we compare avalanche and snowball methods. After that, we reveal the deferred interest trap and how to avoid it. We'll follow with specific tactics to fix the cash flow gap from both income and expense angles. We'll also provide tools including trackers, timelines, and flowcharts. Finally, we'll test your understanding with quick quizzes. Let's set the stakes. If you're carrying more than $23,000 in promotional credit card balances and can only put $1,000 toward debt when your required minimums total around $2,000, your current approach isn't sustainable. Once promotional periods end, interest rates of 20% or more can apply, turning manageable balances into rapidly compounding liabilities. Therefore, we must shift focus from paying off everything to preventing the highest interest damage first. Here's how 0% APR backfires. First, the promotional period ends while a balance remains. Then, one of two things happens. Under a standard promotion, the card switches to a high ongoing interest rate, often 20% or higher. Under a deferred interest promotion, if you fail to pay the entire balance by the deadline, the issuer applies all the interest retroactively from the original purchase date. Either path leads to a surge in monthly interest costs, intensifying cash flow strain. That strain increases the risk of missed payments, late fees, and potential credit score damage, which in turn raises costs elsewhere. This is why the clock, not the balance, becomes the real enemy. Now let's switch strategies. First, gather data on each card's exact post-promotion APR. This determines your payment order. Next, implement the debt-avalanche method, concentrating your entire available payment beyond minimums on the card that will have the highest future APR. However, there is a critical exception. If any card is a deferred interest promotion and you cannot clear it by the deadline, that balance must take priority over all others, because missing the deadline results in retroactive interest from the original purchase date. Continue paying only minimums on all other cards. Here are your immediate steps. First, list every credit card with the current balance, promotional end date, the exact post-promo APR, the required minimum payment, and whether the promotion is deferred interest. Next, rank the cards, placing any deferred interest balances first, and then ordering the rest by highest future APR. Then, pay minimums on all cards, and send the remaining budget to the top-ranked card. Set calendar alerts 60, 30, and 14 days before each promotional expiration date. Review your plan weekly and update priorities as deadlines approach. Meanwhile, begin closing the budget gap by boosting income and reducing expenses, especially fixed costs like housing. This flowchart shows the routing logic. You begin by listing all cards. The first decision is whether any are deferred interest promotions. If so, you target the deferred interest balance before anything else, and pay minimums on all other cards. If there are no deferred interest balances, you sort by highest future APR. You then apply all available funds beyond minimums to the selected target. There is a loop that checks whether the target balance has been cleared. If yes, you move to the next highest APR card. There is also a timed check for promotions ending within 30 days. If an expiration is near, and that card either has the highest future APR or is deferred interest, you adjust your priority accordingly. Otherwise, you continue. The process ends when all balances are cleared and interest has been minimized. Here's a comparison. The debt avalanche targets the highest future APR first, which minimizes total interest paid and is especially effective when promotions are ending soon at high rates. The debt snowball focuses on the smallest balance to create quick wins and maintain motivation, but it can lead to paying more interest over time. In a high-stakes promotional environment, with looming 20% or higher APRs, the avalanche is generally superior, except when a deferred interest balance exists. In that case, deferred interest takes priority. Let's examine the deferred interest trap. With deferred interest, if you miss the payoff deadline by even a small amount, the issuer charges all the interest retroactively from the original purchase date. That can add hundreds of dollars instantly. Therefore, you must prioritize these balances above all others, regardless of the exact expiration date or the future APR on other cards. For example, if you made a $2,000 purchase at 0% for 12 months and missed the deadline by $100, you could still be charged 12 months of interest on the full balance. This is why identifying deferred interest is critical. Use a tracker like this. Include each card, the balance, promotional end date, the exact future APR, whether the promotion is deferred interest, the current minimum payment, and the resulting priority rank. In this example, the store card with deferred interest is ranked first, even though its balance is smaller. Next is the card with the highest future APR. Then, cards with lower future APRs follow. Update this table monthly, and anytime a promotion or rate changes. To solve a $1,000 gap, where $2,000 are required, and only $1,000 is available, you must attack both sides. First, aggressively increase income through overtime, a second job, freelancing, or high-demand gigs. Set a concrete income target sufficient to close the shortfall quickly. Second, perform a deep expense dive, focusing on fixed costs first. Consider adding a roommate, subletting, or temporarily downsizing to reduce housing costs. Then trim subscriptions, transportation, and food spending. Every additional dollar must first ensure minimum payments are met, and then be directed to the current target card under your priority sequence. A Gantt-style plan helps you visualize deadlines. Plot every promotional end date across the next 1 to 3 years. Add buffer milestones at 60, 30, and 14 days before each expiration. This ensures you have time to adjust payments or reshuffle priorities if necessary. Sequence your targets so that the highest risk debts, especially deferred interest and highest future APRs, are handled before their deadlines. Quiz time. Which balance should be prioritized above all others when planning payments during overlapping 0% promotions? Option A. The card with the highest future APR. Option B. The card with deferred interest terms. Option C. The card with the smallest balance. Option D. The card with the earliest promotional expiration but normal terms. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The card with deferred interest terms. This is because missing the payoff deadline can trigger retroactive interest from the original purchase date, which is more costly than simply rolling into a standard high APR. Therefore, deferred interest must be addressed first. Here's another question. You have $1,000 available, but minimum payments total $2,000. What is the best immediate approach? Option A. Split the money evenly across all cards. Option B. Pay the smallest balance first for motivation. Option C. Pay minimums on all cards, then send all extra to the highest future APR card, while increasing income and cutting expenses. Option D. Stop paying one card entirely to focus on others. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Always protect yourself by paying at least the minimum on every account to avoid fees and credit damage. Then apply the debt avalanche to the highest future APR card to minimize total interest. In parallel, close the cash flow gap by raising income and reducing expenses so minimums are consistently met and extra funds can accelerate payoff. Here are the key takeaways. Time is expensive because a 0% promotion can quickly convert to a 20% or higher APR. Prioritize deferred interest balances before anything else, then apply the avalanche method to the highest future APR. Always pay at least the minimum on every card to avoid late fees and credit damage. Close your budget gap by increasing income and cutting fixed expenses. Finally, track your accounts carefully, set alerts before deadlines, and adjust priorities as the situation evolves. Before we wrap, a quick disclaimer. This content is for educational purposes only and is not financial, legal, or tax advice. Your situation is unique, So consider consulting a qualified fiduciary advisor or a reputable nonprofit credit counselor. If you are at risk of missing minimum payments, investigate accredited nonprofit debt management plans. Make sure any organization you consider is transparent about fees and outcomes. Here's your 1-minute action plan. First, list every card and document the post-promo APR. Then flag any deferred interest promotions. Next, rank the list with deferred interest first, followed by highest future APR. Pay minimums on all accounts, then allocate all remaining funds to your top target. Close the budget gap by adding income and cutting fixed costs right away. Track promotional deadlines using 60, 30, and 14-day alerts, and reassess priorities monthly. Thanks for watching. If this was helpful, please like the video, share it with someone dealing with promotional credit card debt, and subscribe for more practical guides. Post your questions and your personal plan in the comments so we can help you refine it. See you in the next video.